Hello, everyone, and welcome to Long Options. I am Rachel Deschelle, Senior Manager of Trading Services and your host for Long Options. And this is a class where we focus on option buying strategies. We make the assumption that you're already familiar with the basics of options. So if you're not, you are welcome to stay, but we do have another playlist or another class called Getting Started with Options that you may find useful. So today we're actually going to go through some protective puts and hedging strategies, talk about some ways, different tools to make those strategies happen. And then I am also joined today in the chat by Brent Moores. So if you have any questions, comments, requests today, please chat those in. Brent will take care of most of those, but I'll keep an eye on the chat as we go today. Please follow Brent and I on X. He is Brent Moores CS. I am Rachel CS. And please give this video a like and please subscribe to us on Trader Talks at Schwab Coaching for our YouTube channel. So before we get started today, let's just get into a couple important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information here we're going to cover is for general informational and educational purposes only and should not be considered any type of recommendation or advice. And we are going to go through the paper money software application. There are some differences between that and our live trading as well. So keep that in mind as we go today. So today our real agenda here is going to discuss the concept of long options. We're going to start with our market overview, really reviewing some of our old trades, and then discuss the concepts of long options with price, time, and volatility factors, place some example trades on the paper money platform. But before we dive in, we have an announcement here with some upcoming workshops and market drive events. We have the next one coming up here in Miami. It is the advanced options. I will be at that one on December 19th and 20th. Give me a holler if you are going to be at that one as well. Then we have a couple just technical analysis and option strategies workshops. We have one at the beginning of January in Dallas. We have one at the end of January in Bellevue, Washington. So keep an eye out for those ones as well. Now let's get into our Thinkorswim platform and go through our market overview, kind of how we always start out this class. So last week we obviously saw, or I guess the last couple weeks, we've been seeing that bounce from that long-term support. We reclaimed that 20-day and 50-day moving average. We've been kind of trading up around there, but we've had a slight little pullback the last couple days, kind of leading into this Fed announcement tomorrow here. So probably the first kind of levels to watch in the near term are probably going to be this 20 period moving average here in blue, right around 47,200 will probably be that first level to watch for the Dow Jones. And that is about not even a 1% move from where we're at now on the Dow. Let's take a look at the NASDAQ here as well. Kind of same thing that we are seeing. We've still had this bit of a short-term uptrend here, really trying to reclaim this old area of old resistance, and we haven't quite yet closed that entire gap from the beginning of November. We tried a little bit yesterday, but still didn't reach that entire envelope of space there before kind of pulling back a little bit today. But again, that 20 and 50 period moving average, they're not too far off, about a 1.5% move from where we are now. So that may be a valid level of support if we should see a little bit of a pullback here in the near term, giving back a little bit of this gain that we've created over the last couple weeks. And then we have the S&P 500 kind of making that similar type of trading formation here. We haven't yet really reclaimed those former highs there. We're really kind of stalling out at that prior resistance right around those prior highs from really early November and again mid-November here, where it's kind of pulling back to that level right around 68.90 or so. So that's kind of the first level of resistance to watch. And then obviously we have those all-time highs. We are not too far off of those by any means. Let's just kind of do our quick little measured move here from where we are now to our highs, we are less than 1% away. So we are just shy of 1% away from those all-time highs. And then if we look from the 20-period moving average, where we may find an additional piece of short-term support, maybe even right from that tiny gap in between those candles there, that's not even a 1.5% move there for possible support. So a couple areas to kind of keep on the lookout. Something notable here though today, when looking at our market overview, we did see small caps are actually breaking out today, forming new all-time highs. One notable thing about the small caps, obviously, we're seeing them kind of lead the indexes or the other major indexes here into reaching those all-time highs, whereas the other indexes are, like we showed, about a percentage off from those all-time highs. Something notable here though, as price is making higher highs, because it's making a slight higher high, we have our RSI indicator not necessarily making a higher high there, not even reaching overbought levels in the RSI either. So that may give us maybe a little bit of a signal to this being maybe a little bit of an early breakout there, since momentum may not be fully confirming that move, since it's just a slight bit of a divergence, but we'll obviously have to see, because trend and price obviously comes first. So that's something notable there. Now, as far as the transports, I know this had been one that we looked at before. The transports have definitely been breaking out the last couple weeks. They've reached those overbought levels on that RSI, kind of coming below that 70 or coming close to below that 70 level there today. So probably another kind of place where the transports may find support here from these former highs here as well. So just different little pockets to look at in the market, maybe different groups of stocks that you may not be used to looking at here. Now let's go through and review our options portfolio. So looking at all of our trades for long options, these are the trades that we are still in. We did close out, I know we had a trade on Delta over the last couple weeks. We did close that out last week. Shortly thereafter, when I moved up the stop, I just decided, oh, well, we're going to take some profit. And so I think we took about a $800 or so profit there. So we closed that out at a nice little gain there on the 3rd. And then as far as some of our other trades, we are still in those, taking a little bit of a hit on CNC. Overall, taking quite a bit of a hit on the day just from Affirm, and we can look at the charts of some of these as well if you'd like, but this just gives you kind of the snapshot or reminder of the trades that we are still in. Now, if I go to the charts tab, we can just kind of do a little review of the trades that we are still in this case. So Affirm, we went long a put because we saw this downtrend here with lower highs, lower lows. It looks like it's trying to creep above its 20-period simple moving average today, with a possible bullish engulfing candle there, engulfing the prior 2 days of trading. So that's something that we could look for follow through tomorrow, but we have our stop in place for that. And then as far as Alibaba, we also had a long put on this one as well, because this was more of a trend trade that we were looking at, lower highs, lower lows. We saw the gap down today with that rejection of that 20-period simple moving average. So another thing to watch there. CNC with this one, and I'm actually going to get rid of this RSI just to hide it from here. So CNC, this was one where we took a bull call trade, bull call where we bought the breakout of this possible cup and handle pattern. And since then, we've had a little bit of a pullback to that former resistance, now new support, kind of resting right at that level, right above that 20-day simple moving average as well. But something else, it looks like it's forming a little bit of almost like this pennant pattern here that we're seeing, with just this little bit of this pullback. So if we do see that continued move higher, that may give us, with this pattern, a possible $4 or $5 move to the upside there if we just kind of take that flagpole add it to a possible breakout if we should see that bounce from there at support. So that's that trade. GEHC, we traded this big range breakout here. We even noted that there may be this possible pennant pattern last week that kind of formed when we had that retest of support, just like we kind of saw in the last one as well. We are still in that trade, moving that stop up as we go. And then TJX, this was our leap trade. This is because we are in a long-term uptrend for TJ Maxx. So we still have that stop set in place there following our trade up. Now today we're going to take a look at a couple different examples, like I mentioned in the beginning, on just talking about hedging our portfolio in general, but also just placing long hedges on a long stock position with using protective puts. So we'll kind of cover a little bit of the basics of some different things that you could use when possibly considering hedging a portfolio, a couple different tools here. We won't go too deep into the weeds on the portfolio side because I know Brent teaches a class called Managing an Options Portfolio, and then we have other classes on like ETFs and index options as well that may tie in a little bit better to that concept. But I want to definitely cover some different tools that we could use if you are considering putting on an overall hedge for your portfolio or just for a particular stock position. So let's just start out with when do we hedge? Why do we hedge? So when do traders typically put on a hedge for their portfolio or for a particular stock position? Well, they typically put on a hedge to protect it for any type of uncertainty. So this could be any type of possible news event coming out, an earnings release, maybe economic data, those types of kind of like reports, maybe a rate cut decision, the things like that, kind of leading into these larger announcements for a particular stock or larger announcements that may impact your portfolio that could produce a little bit of volatility for your portfolio. So that is why we may consider as traders placing a hedge on in case of a possible pullback or increase in volatility, some factors like that that may give our portfolio or our position a little bit of padding or a little bit of protection. So in the portfolio sense, if we are managing an entire portfolio, and I'm just going to look at the Analyze tab here and go to the Risk Profile tool. So if we're managing an entire portfolio, I know sometimes we may look for a benchmark that may best represent our portfolio. So a lot of times traders may come in here, if they have a long stock portfolio, they may come in the Analyze Risk Profile tab, and they may want to take a look at their portfolio on this risk profile. Now, right now, you actually just see this as TJX because we have single symbol selected here. But let's just say we want to beta weight our portfolio, for example, to the S&P 500 to see what type of percentage move in the S&P 500 is really going to impact our portfolio and by how much. So what you can do here is you can take your entire portfolio, click on single symbol, change that to portfolio beta weighted, and then just change this beta symbol at the top. You'll actually see this symbol changes to beta symbol, and you can type in SPX as our example here. Now, if there's an index that better represents your portfolio, whether it's the NASDAQ 100, whatever it may be, the small caps, if you're heavy small caps, we're just kind of using this as an example as we go. But you'll kind of see here, this will give a risk curve depending on movements in the underlying index and what your portfolio will essentially do. So down here at the bottom, we have all of the current trades that we're in right now. So all of the trades that we're in for this portfolio overall, our long stock positions, our long puts, long calls, any of the trades that we're in will show under here. So when you do this for your portfolio, or when traders will do this as well, you'll see all of those as well. One thing that traders may want to do is click on this three-line menu to the right-hand side and just delete, whoops, if that little box disappears, there we go. Delete simulated trades, because if you've placed simulated trades or you've analyzed simulated trades in this tool, there may be still some hidden in here that may be actually affecting your risk curve. So this is probably one good thing to kind of start, is just by deleting out all of those simulated trades. Of course, you can hide and unhide them here. So if you wanted to hide a position or hide a simulated trade, you could use the check boxes to do that. So that's another thing that you could do. But if I'm looking to hedge an overall portfolio based off of maybe that Fed announcement or economic data, whatever it may be, I may, as a trader who's looking to hedge a portfolio, I may use index options, I may use ETF options, I may use calls on the VIX, I may use leveraged products, or I guess inverse products, I would say. So there's many different ways that you could, in a sense, hedge the risk in your portfolio or add uncorrelated assets to there. Obviously, this isn't an index options class. This isn't an ETFs class, so we're not going to talk about this today. But what you could essentially do when you are managing that options portfolio and considering a hedge, you could go to add simulated trades and add on possible put options to see how your risk curve changes. And so you'll kind of see that as we get into a long stock example with a protected put. But this will just kind of give you an idea as far as what the index value is going to do based off of the movement of kind of our portfolio. So here, what some folks tend to look at on the price slices is they may go to set slices and they may look at 7 rows with a 5% step. And this is essentially all this is going to give you for your view on your risk for your portfolio. Is it's going to give you where your profit and loss would be now in your overall portfolio based off of where the index is now at 0. And then you'll have those 5% increments to the upside and to the downside to see where your profitability would essentially be if the index made those types of moves. So in this case, you can kind of obviously change these as an example, and you can see because of our portfolio, it is kind of showing this almost like V-shaped type of shape here on the risk profile. This is telling us that we have a mix of bearish and bullish positions, almost kind of to the equidistant point here to form this V. Now, if you have more of a kind of slanted portfolio where you have almost this line that starts in the bottom left corner, accelerating to the upper right corner, that would tell you have mostly a long portfolio, or most of your portfolio is bearish overall. If you start to add possible simulated put trades, whether it's index ETF puts, whatever it may be, into this picture, you'll start to see that risk curve kind of start to decline on the, I guess, on the long side, because it's giving you that added protection on the downside as well. And you'll kind of see these numbers change as well. So I know we can't give too much of a live example today, but I just wanted to show you that quick little tool there. If you are managing an overall portfolio and you are considering using long options to possibly hedge an overall move in your portfolio, this is one tool you can use for that. But let's take a look at one example that I came up with here. A stock that doesn't necessarily have any type of upcoming earnings, any type of upcoming events, but maybe just has a short-term break in the trend, a break of one of the moving averages, and maybe it's something that we just want to hedge in the short term because we are long the stock. And so in this case, I used Wayfair as an example. I am long 100 shares of the underlying stock. So my risk curve, when we look at it in a couple minutes, it's just going to be a slanted line going from the lower left to the upper right. And we are going to place a protective put on that option to really protect our downside risk, because with protective puts, or I guess with wanting to protect our long stock position, we could do that obviously in a number of different ways. We could sell some of the shares of stock. We could put a stop order on our position as well, just to protect it from the downside. But if we don't necessarily want to sell the position, we want to keep that position and maybe hold it through a little bit of a downtrend or a little bit of volatility, we may use that protective put option to do that. And so that's why we're going to go through this example in this case. I'm keeping an eye on the chat as well here to see if we have any questions so far. Let's see. Okay. I don't see any, I guess, too pressing of questions. I know we had a question about TJX. We actually see that in the watch list there where that's trading right now. That's around like 153 or so. So you can keep an eye on that. Now let's look at some technical levels for Wayfair. Well, we know that they don't have any upcoming earnings. So there's no upcoming big announcement that we need to hedge. We may just want to hedge this little bit in a downtrend, or maybe this technical pattern that we're seeing on the chart. So I'm just going to draw a couple of things from a technical perspective. I obviously see this old resistance, new support kind of hanging out right around this zone that it's trading around right now. So I'm going to zoom in a little bit closer to that so you can kind of see that here. So it's kind of a wide zone here, really from 95 down to 90 or so, where we kind of saw the stock price trade in around. So that may be one zone that I'm going to watch and be kind of hedging against if we continue a move down below there. Another kind of technical setup that I see here that could give us a bearish type of, I guess, almost like bearish confirmation or bearish type of move in the near term with Wayfair could be this possible pattern that we had with this breakdown of a possible double top. So we almost see this neckline getting crafted right around that $94 level or so. And then we have these highs being made almost at the same price. If I just kind of draw this here, draw this here, it looks like we've had a bit of a breakdown from that double top. We've obviously had a little bit more of a breakdown today, but price is trying to reclaim that level at the same time. So we don't know if that's going to be more of like a failed pattern, so to speak, in that case, but maybe we do want to hedge against that in case it is going to just go for that, I guess, resistance touchback and move further down as this possible pattern would suggest. So in this case, we did lose the 20-day simple moving average. We kind of had that big red candle over it last week where it closed below there, gap down to support, has really been finding support the last 5 trading days right around the 50-day moving average. It still could have a possible level to move even further as far as just this really wide gap that it still possibly has left to fill. So that even could put us all the way down near this like $87 level, giving us possibly like an $8 move to the downside at this next level of support if we can't fully reclaim that 50 period simple moving average. So that may be something we want to hedge against in that case. Now, another consideration here as well with a possible hedging strategy is a lot of the times, since we talk about just the price and the premiums of our options, a lot of the times when we are looking to hedge a possible event, hedge a possible big move in a stock or in our particular portfolio, we also want to look at levels of volatility because we don't want to be overpaying for that protection, right? So I added the implied volatility study here, and this is just going to show us that we are at relatively pretty low levels of implied volatility. And you can see here we have an implied volatility of 58.5% or so. And if we actually go back to the trade tab over here and we look at today's option statistics, which I know we pull up in almost every class here, we're looking at the current IV percentile, and that's going to rank the current level of implied volatility for this stock to itself over the past year on a scale of 1 to 100. 1 being the lowest level of implied volatility the stock has seen over the past year, 100 being the highest level. And right now it's ranking right around 9. So this is kind of telling us that it is a very low implied volatility environment for this particular stock. So that would give us a kind of a decent environment to be buyers of options in this case, but not just buyers of options. Also, because of the low volatility, this can give us the opportunity to hedge at a cheaper cost as well, to just pay a small premium for that right to sell our shares at that particular strike price if we wanted to, or just to kind of hedge that downward movement in the stock without necessarily having to exercise the option, more looking to possibly close out that option like we do most of the time in this class anyways. So if we look at the trade tab here, we just kind of looked over, I guess, actually I'm going to jump back to charts for a second. So we looked at this kind of bearish possible formation, and the start of this type of formation really started about a month ago in the beginning of November here, where we saw this big possible double top there, which is that bearish reversal. Still not confirmed yet because we need to see that percentage move outside of that neckline support. But if we wanted to hedge against that timing may be something that we take into consideration as far as, hey, this took about a month to craft out this type of pattern. We may want at least a month on as far as a hedge. Now, if you're hedging an upcoming event, whether it may be earnings or an economic report, you may look at a shorter term expiration because you may be just holding that option for a couple days or so, really looking to swing trade that pretty quickly. So you may be looking at those shorter term expirations. Obviously, keep in mind you are going to have a greater time decay in those, because obviously the closer and closer you get to expiration, you are going to have a greater time decay there. But if we are just looking for a possible short-term hedge here in the over the next month for Wayfair, we may be just looking at the expiration of the 20th of February, 73 days left until expiration there. So I'm going to scroll down here, and this is telling us based on the implied volatility of the underlying stock over the next 73 days, there is an expected move of the stock to go up or down $22 or so. So up or down $22 is really the range based on the implied volatility that we're seeing that this stock could really trade in. So a lot of the times when we go through this class, I know we look at a lot of times trend trades or pattern trades. And for a lot of those, we like to look for stocks that are in the money with a good amount of intrinsic value with a larger delta. So if we were trend trading Wayfair today and we wanted to take a bullish stance, if we did see that percentage filter or that breakdown from that possible pattern, maybe we saw a close below the 50-day moving average, we may want to take a trade in here with a delta greater than 50, maybe look at a delta closer to 60, somewhere around there. But if we are possibly hedging an option, we may just want a little bit of a protection to the downside. We may be looking to buy an out of the money put option in this case, maybe with a delta right around 30 or so. So we may look at the 85 strike around 28 delta, or the 87.50 around a 31 delta. That way it just gives us kind of a little bit of, we're paying a little bit of that premium should it go down to that price, because over the next couple months, there is a possible move of $22. And if we just buy the 85 strike put in this case, that's just a $10 move from where we are now. And we can go through kind of the simulations of what that would look like. but we would be essentially paying about $550 overall with our max loss. So that would show us how much we could lose with paying for this premium to protect 100 shares of our stock if it goes down to 85. So we would still have the right to buy, or I guess the right to sell our shares at 85 if it goes lower than that. But in this case, we may just not want to sell our shares at all. We may want to keep our shares and obviously just hedge or protect and make kind of money in the upside of our option and turn around and sell it if the price of the stock goes down. So in this case, we can see that delta of 30. I know some of you are familiar with delta in this class. We'll just kind of review this a little bit more, but your delta is that probability of that option expiring in the money. It's also going to give you that theoretical move per $1 move in the stock. And so because puts move inversely, they're going to have a negative delta as compared to the calls, because if the price of the stock goes up $1, this option is going to theoretically go down 28 cents or so in this case, and vice versa. So if the stock goes down $1, our option will theoretically go up 28 cents or so. Now I see a couple questions in the chat here. Let's see about are there any classes from, okay, so it looks like Brent, you put in a class from there as far as the option statistics. I believe we also have a video within the education tab. I'll go to that in a second there on just the today's option statistics in general. And then as far as the island gap reversal pattern, I saw a couple comments in the chat about this being a possible island gap reversal. And what that technically is that depending on which direction the island really tends to take place, depends on whether it's a bullish reversal or a bearish reversal. So if this was kind of stacking up to gap down and trade for a few days down here at support, and then all of a sudden, let's say tomorrow or within the next couple days, it gaps up above that level, this would kind of be that island as support down here. And you would have gaps in between kind of separating it so it's not really touching either side. So that would be, in a sense, a bullish reversal. Now, if this kind of formation really occurred above a top, so let's just say the stock gapped above a resistance level, kind of formed this consolidation for a couple days and then gapped back down, that would be a bearish island reversal in that case. But you obviously don't know it's an island reversal until you see that next gap, which we don't know about there yet. And then let's look in that education tab for the Learning Center, because I believe we do still have that video on there. Let's just take a look. I know we used to. Under the Think manual, we do have some videos here. I'm going to go under the Trade tab. Let's see. Under All Products, today's option statistics. Okay, so we don't technically have a video within the Learning Center on today's option statistics. We actually used to, but like Brent said, there may be a couple as far as a webcast that dives into it a little bit deeper, but this will kind of show you just the definition to really everything that you're going to see on that page. So hopefully that helps a little bit. I know it's not necessarily a video. You'll have to read a little bit, but that'll give you the definition of everything you're really going to see on that page. Okay, let's go back to the Trade tab over here and let's take a look at that 85 strike, like what we talked about. So if I am going to pull up this trade, I already kind of talked about how it is going to give us a pretty small delta. So if the price of the stock really moves up in our case, we're not going to have a huge damage to the premium that we're going to be paying, since theoretically the stock would only go down, or I guess the option price would only go down 28 cents in that case. But if the price of the stock is going to move, I guess in a sense, in our bearish direction towards our strike price, you can kind of notice that as the price of the stock is closer and closer to that strike price, the larger that delta gets. So the larger of the move that we'll see there on our option in this case. So I'm actually going to click on buying this option here. and I'm going to right click on the trade and go to analyze trade. And we're just going to analyze this on our risk profile. Now we do have to remember we have this set to portfolio beta weighted. So at the bottom here, we're going to shift this from portfolio beta weighted to single symbol here. And this will just take us through Wayfair in this case, where we have our long stock position as well as our long put position in this case. So if I just uncheck that long put position, you can see here that this is just going to obviously give us that straight line, because the most we can lose is what we paid for this stock, which we paid $94.24 on 100 shares. The most we can make is if it goes up to infinity there in that case, okay? Now, if we throw on that put option there, in this case, this will kind of give us a little bit of protection with this particular stock price, okay? So here we can see the most we are risking in this case is going to be really down to this max loss right around where we hit this $85 level, because we have the right to sell our shares at that price. So that's kind of where we're protecting ourselves from that sense, where it could kind of work as a type of order in that sense, where we have that right to sell our shares at that price, especially if it goes below it. But in this sense, we can see with a long put option in this case, it's still going to give us this overall bullish type of kind of profile here, because obviously we are bullish the stock, but it's just kind of capping down our downside risk here in this case, with us only really risking $550 in this particular trade. So let's just say the price of the stock goes, in a sense, in this case, down 10% in this case with Wayfair. So if it goes down 10% in this case, you can kind of see this little price slice here. This is going to show us where it goes down 10%. This is giving us a price of 86.16. So with these two trades placed together, that would still only put us at a little bit of a loss there, because we would obviously see the loss on the stock, but we would at the same time be gaining on that option. So still, it would give us less of a downside risk in that case, because we're placing that protective put. But if we look at 86.16, so this would be about a $500 loss if we went to that price today. Let's just uncheck this protective put and place our stock over that same price. If it went to that price today, if it made that 10% move, theoretically, we'd be at over an $800 loss. So you can obviously see how that protective put can really come into play to really pad out that loss to the downside, and it starts to pad it more and more as the price of the stock goes down too. So I see a couple questions in the chat. Oh, and I see a survey in the chat today as well. So please definitely take a minute or two to fill out that survey. I always read all of your guys' responses within the survey. Love hearing back from you. We love incorporating that into these webcasts here. So please definitely take the chance to fill that out. And then I had another question on just the liquidity of the options in this sense. So on the W option, how do I measure if it is a liquid option? So a couple of things that traders will do is they'll use the open interest as well as the volume, and they also will look at the bid-ask spread as well. So in this sense, we do have a level of liquidity because we do have a few hundred shares that are still in, or I guess a few hundred contracts, I should say, that are still in here with open interest. And then we do have kind of light volume here on these contracts as well. What I would pay attention to, in addition to the level of open interest and volume there, is just this spread on the bid and the ask. And in this class, we kind of use a guideline of no more than a 10% spread on the bid and the ask there. And this is about a 40-cent spread, which is giving us less than a 10% spread there. So that's telling me that I still have a tight enough spread. I'm seeing volume on that contract today. I have 120 contracts in open interest. So that'll give me enough liquidity for this one in particular. So hopefully that helps answer your questions there. Now, I have another question in the chat about a caller position as well. Now, we don't talk about that really in this class because a caller position is not only just using this protective put on the downside, it's necessarily also putting a cap on your upside, but it's selling essentially a call on the upside to actually pay for that protective put on the downside. So sometimes traders will call it a zero cost collar if they think the price of the stock will stay in a particular range and they still want protection to the downside. They may not be wanting to spend over $500 on this particular option. So they may sell an option to the upside, let's say around 110 or so, to pay for that options protection, but obviously that's going to cap out our upside because we'll have the obligation to sell our stock if it reaches that 110 strike price there. So that is that zero cost collar position. You can see those two kind of net each other out. It's not really a trade we talk about in this class just due to the nature of this being a long options class, but I know our advanced option strategies classes cover that a little bit more. So for this one, in this case, we talked about a few different things for protective strategies, or protective puts. We talked about just upcoming events, maybe upcoming shifts in the shorter term trend, some of those technical levels to watch, maybe upcoming earnings, upcoming Fed announcements. So just some uncertainty that's in the market for a particular stock, whether it's technical, whether it's fundamental or macro based, whatever it may be for your stock or your portfolio, that could give you that reason to hedge. And obviously that's just one of the reasons that we use options in our portfolio, in addition to the speculation or growth component, which we talk about a lot in this class, and then the income component that we don't talk about really at all in this class, since we're not talking about selling strategies. So that was kind of the first consideration there. Another consideration we talked about is kind of those levels of implied volatility that we're looking at as well. We don't want to overpay for our protection. We want to look for muted levels of implied volatility because a lot of times volatility is mean reverting. So low volatility tends to switch to high volatility tends to switch to low volatility. It's just kind of how it works there. I know a lot of traders will look at the VIX and they'll kind of use that as well as an indicator as well. But for this particular stock, we talked about volatility as a factor. We also talked about time decay, how long we are looking to possibly hedge for in this particular stock over the near term. And so we talked about that as well. And then we talked about just the downside risk that we are looking to take on, and maybe where we would want to select a strike price with a possible move in the stock and just a smaller delta that we may look at as an example, as far as just paying a little bit of a cheaper premium up front, watching that delta get larger and larger as the price of the stock moves down, but not necessarily taking a huge hit on that option if it does not necessarily pull back in that case, if we don't have to necessarily use our hedge. So given that, I'm going to hit confirm and send in this one, place this in the long options trade here. We know that our max loss is 560 for what we're paying for it. Our max profit is 79.40. That's if that stock goes down. We're going to place that in the long options trade, hit send. And we are going to be protected on our long stock portfolio just over the next month or so, as we're going to kind of keep an eye on this stock here. But hopefully the things that we covered today just kind of help reinforce maybe a process for protective puts, maybe even some additional tools to use in the Analyze Risk Profile tab for either beta weighting your portfolio and putting on these protective hedges for your portfolio overall, or just for a particular long stock position. So thank you for all of your engagement in the chat. Please do not forget about that survey there. I know Brent posted that a couple times there. And Brent, thank you so much for all your help. I know they kept you busy in the chat there. Thank you all for your engagement today in today's session. And please give this video a like if you found it useful. Please subscribe to our Trader Talks Schwab Coaching page on YouTube. But thank you all and have a great rest of your day, traders.